line with our business, we continue to see growth across all our businesses. We have seen that the company continues to do well on the back of all the efforts that we've been making, and we are seeing that we are able to deliver on the margin promise of our international business, while we continue to see good strength on the Prime Focus Technologies and the India FMS business. In line with the changes that we see, we have transitioned Vikas Rathi, our prior group CFO, to focus exclusively on the Prime Focus World and DNAC business since he moved to London. And we have reappointed Nishant Fadia, who's been with the group for over the last 18 years, to come on board as the PFL CFO. We have seen a lot of success across a lot of the key marquee projects, from movies like Thor, Justice League, and other marquee Hollywood titles, followed with strong Bollywood pipeline as well. We continue to see strength across all the key projects across all these verticals. We have films like Padmavat, which released and is doing exceedingly well. We have a strong pipeline of Bollywood projects coming down the pike in terms of the rest of the year, with films like Robo 2.0, Thugs of Hindustan, etc., to name a few. We continue to see that our technological transformation on the Prime Focus Technology side and the delivery to our clients is continuing to be rather robust, and we feel that we are at a great inflection point across all our key businesses to continue to deliver on the promise that we laid out to the shareholders over the last few years. With that, I'd like to hand the call to Ramki, who can walk us through the Prime Focus Technologies business, and then Nishant can walk us through the financials. Thank you.
Thank you, Namit, and good afternoon, everyone. We're actually pleased to announce strong progress in the global expansion with our increased international market contribution at about 41% this quarter. This is the first time when, our international revenue mix has gone above the 40% mark, and that's noteworthy. The annuity mix of the business continues to be around the 72% mark, and the product to services mix is again quite favorably in the 52 and to 48%. I think some of those metrics have been quite steady. We added some pretty interesting new clients. Discovery was one of them, and we added Spotify as a client, and these are to name a few. We also have sort of added more new business from existing clients like Hearst, Sony Pictures Entertainment, BCCA, and Star, and Turner as well. So I think all around, I think that's what shaped the progress that we made in the quarter. And I also want to sort of share with you that as increasingly video is becoming the table stakes, the video agency offering that we have, which is targeted at sort of brands in South Asia, I think that business continues to do very well continues to grow with client additions like Vodafone Play, Oppo, Ghana, Big Bazaar, and ICSA Prudential, and so on and so forth. So I think that sort of is the other sort of growth engine that sort of is coming to bear, and it's fairly an exciting market that we are going after as well. All of this is consummated also by the launch of the next generation product. Now the next generation Clear product is in the hands of customers. We already have customers in production, transition clients like Warner Brothers and Fox onto the new platform. It's exciting stuff for us there. And then we have now that truly the concept of one software, the media ERP software being that one software for the enterprise, really consummated in a true form with this launch of this product. I think that augurs very well for the future. Again, we've actually revamped our sort of entire sales effort globally, which is I think where we've actually sort of increased our SG&A spend as well by increasing our teams, increasing our footprint, and have sort of continued to invest on growth. Our products continue to sort of win awards. One of the most noteworthy ones was the TV Technologies 2017 Product Innovation Award for our work order management sort of module, and I think that's a good way to sort of finish the quarter. Again, overall, I wanted to say that we continue to stay focused, and I think we do look at some exciting stuff in the future. With that, I'd like to hand over to Nishant for him to take you all through the financial highlights. Nishant.
I'm just going to quickly do the financial highlights and then we can jump on to Q&A. Consolidated revenue for the quarter was up 20% at 609 crores compared to 508 crores in Q3/17. Adjusted EBITDA from an operational perspective increased to 157 crores from 123 crores. EBITDA margin for the quarter was up 25 to 25.8 as compared to 24.1. Non-cash ESOP charges for the period were 4 crores compared to 11 crores in Q3/FY17 and are expected to further decline in line with the guidance we've given earlier. The finance costs for this quarter include a 5.5 crore charge over and above regular charges because of a change in accounting treatment, because the institute has come out with a guidance note on the treatment of redemption premium on the NCDs we have. So that's expensed in the P&L as against the balance sheet debit, which was prevalent in the earlier quarters. There is also a one-time accelerated 8 crore depreciation charge on account of shutdown of a small facility in India. From a 9-month perspective, consolidated revenue is up 12% and adjusted EBITDA grew 30% at 413 crores. From a division-wise perspective, creative services revenue for the period was up 25% at 480 crores compared to 384 crores. Adjusted EBITDA in that business grew strongly to 125 crores compared to 91 crores, and the margin was 25%. On the technology business, revenues increased to 88 crores over 85. EBITDA margin was at 23.6, which is marginally down as we've seen an increase in sales and marketing resources for our next phase of growth in the North America markets. The FMS business has been stable and has clocked EBITDA margins of over 40%. Consolidated net debt as on 31st December is 1,450 crores. And just the last point that the promoter family has issued warrants worth a total of 330 crores, which will largely be going to reduce debt on the balance sheet. Thanks again for joining the call, and we'll be happy to open the line for questions now.
Sure, thank you very much. We will now begin with the question and answer session. Participants who wish to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Dimple Kotak from SKS Capital and Research. Please go ahead.
Yeah, hello sir. Thanks for the opportunity. Sir, I would like to understand that there is an immediate payment of rupees 190 crores due in November. So how are we going to pay that? Is it through the warrants?
Yes, largely that will be taken care of through the warrants.
And at what price the warrants were issued?
106.
106. Okay. So there were plans that the company might get listed in the global bourses. So where do we stand there?
So as a company, we obviously evaluate whatever options are there in terms of value unlocking and growth prospects continuously. And one option obviously is listing. So as and when we have more firm plans or more concrete plans, we'll obviously come back to the market. But currently, that's it's just in an evaluation phase.
Okay. And sir, the 330 crores which is being infused by the promoter, so is that via a stake sale in the subsidiary, promoter stake sale via the subsidiary, or just want to understand where the 330 crores is coming from?
It's directly into the parent.
No, it is infused directly into the parent. I agree that. Hello?
Yeah, go ahead.
Yeah, but just want to understand that the promoter has got this money. Is there a stake sale in the subsidiary of the promoter or from where?
No, it's from his own sources.
From his own sources. Okay, sir. And are we on the track of reducing debt by 300 to 400 crores in the next 2 years?
Yes, I would. I don't see any reason why that will not happen.
Okay, sir. Okay. That's all from my side, sir. Thank you so much.
Thank you. The next question is from the line of Hafiz Patel from Motilal Oswal Securities.
Sir, could you help me with the gross debt number as of December 17?
It's about 1,550 crores, 1550.
That's the gross debt, right? Yes. And sir, still excluding the impact of 55 million, which is a one-time cost and finance cost, the interest cost still seems to be high. So, I mean, can you throw some light on it?
No, I think, one is obviously, like you mentioned, is the 5.5 crores of extra interest this quarter. But largely, again, you're comparing 9-month numbers. So, from a quarter-on-quarter perspective, there's not a large jump. But from a 9-month perspective, obviously, business has grown since then. We've scaled up in Montreal, in Mumbai, also. So obviously that has led to a little bit of increase in debt, but we are not worried about the interest cost at this point.
And so where do we see the net debt to equity, 2 years down the line?
I think, continuing with the previous sort of question, I think 300 to 400 crores of reduction in debt, or a little more also, in fact, over the next 2 years, especially with the current infusion of equity, should be a very achievable target.
Thank you, sir.
Thank you. The next question is from the line of Piyush Nahar from Jefferies. Please go ahead.
Yeah, hi. Thanks for the question. I just had a couple of questions. First, on the employee cost, that has gone up about 10% quarter on quarter. Is this all because of the ramp up at Montreal, or is there some one-off in that here?
No, that's largely due to the ramp up in Montreal.
Okay. And is this the base that we should see, or there's further hiring that needs to be done in Montreal? Is it fully ramped up there?
I think this is a fairly steady state basis which you can expect going forward. Well, there may be a slight reduction because the average will go down because of more hiring in India.
Yep.
I don't think that it's going up for sure.
Sure. Okay.
I think.
Let me just add.
Yeah.
Sorry, no.
No, I was just saying that basically what you're seeing is, the first phase of the startup costs that have hit the P&L. And, once the facility starts to become much more operational like any of our other facilities, the normalization of cost versus the relative revenue that will come from there will be more apparent. Right now, you see it a little higher only because of the fact that, the costs are ahead of the revenue at this point, because that's the normal phase in which you start the build out.
Okay.
Yeah.
Sure.
Yeah, I think that's a very important point, as Namit mentioned. See, what we're seeing is that there's a lot of momentum and there's a lot of demand coming from the market. I mean, again, there's a lot of dynamism in the market. Netflix and others are starting to do more and more. So, frankly, we've exceeded our plans in terms of adding facilities and adding people. And that's what you see in the December quarter. We went for a very large roadshow, both in India and obviously in Canada, in terms of starting and adding more people. Now they don't come on and start getting involved in revenue producing work at the same time. So that's why you've seen the charges in relation to increased employee costs both in India and in Canada, frankly.
Sure. Okay. Thanks. And secondly, you had mentioned there's about 20 crore cost for one-time setup cost and provisions. Could you just break up that between how much was the Montreal cost and what is the provisions that you have made, and this is regarding to which? What?
Yeah, I mean, just to give you a sense, I think it's about It's about half and half. I mean, basically,
Okay.
we've the setup costs in Montreal is about that. I think as we go through and the business scale up happening, from an accounting perspective, we've taken certain one-time provisions which we think is conservative, from a going forward perspective.
Sure. So this provisions are regarding to more to data side, or is it some write-offs and all that you've taken on?
It's just provisions on on certain debtors
Okay.
as per our best estimate in relation to it.
Sure. And lastly, one final question. This the finance charge, the 55 million that we have taken into accounting changes, this will be a recurring expense, or is this just a one-time that you've taken?
So this will be now a recurring expense. Like I mentioned, the guidance from the institute, which has just recently come, now makes all of these interest charges a debit to P&L. So this 5.5 will be a recurring cost.
Okay. All right. Thanks. That's all from my side. Thanks a lot.
Thank you. The next question is from the line of Kinjal Jagani from Savla Consultancy Services. Please go ahead.
Thanks for taking my question. This is Mulesh Savla. Congratulations for good set of numbers. And question is answered. I have a small query about our conservative approach of writing off some depreciation related to intangibles at about 29 crore and 8 crore of inefficient facilities which was shut down. Are we also expecting similar write-offs in the subsequent quarter?
I think certainly not the 8 crore part, because that's shutdown of a facility. So that's not expected to be a repetitive item.
Okay.
The intangibles obviously will taper down a bit, but it will continue to hit the P&L for the next few quarters.
I see. So any benefits, we don't foresee any benefits out of those assets now anymore?
Out of the ones which we did an accelerated depreciation on, no, we don't.
Oh, okay. Thank you and all the very best.
Thank you.
Thank you. The next question is from the line of Harshit Patel from Equirus Securities. Please go ahead.
Hi, sir. Sir, in this quarter, we see both our technical service cost and technician fees increasing a lot on both year-on-year and quarter-on-quarter perspective. So, sir, what would be the reason for that?
So, Harshit, again, just to revisit what we discussed, it's largely due to the ramp-up which we've seen in our Montreal facility and an increased cost on the back of that.
Okay, sir.
I think one of the ways you should look at this is as a percentage of revenue that's coming through. I think on a percentage of revenue basis, because fundamentally the people fundamentally are driving the revenue part of it. That's the business we have. So as we've grown the people, obviously revenue's also gone up. There is obviously a small sliver of people which were added through the quarter to support the growth as we see in the March and subsequent years perspective, because we've accelerated the growth of that on our creative services side. There's only a small delta in relation to that, but obviously revenue's grown, and you'll see the percentage of revenues, the growth is not there much in relation to personnel costs and technical services.
Okay, sure, sir. Sir, then on the PFT side, sir, we have said in the past that the average duration of our contract would be around 3 years. So, sir, the order book that we give, which is around $200 million, so does it include only annuity revenues, or would it include some portion of the project revenues as well?
No, this is Ramki here. Look, the projects revenue, the way we define it, is projects that we will execute within a 1-year period, or the contracts which are only less than a year. So, when we do give these sort of projections, this would predominantly be projects that are, these are annuity-led revenues only, because, our project-led revenues as a percentage of the order book is very marginal.
Okay, sir. Sir, then in this quarter, the PFT revenues have not grown much, but the proportion of international revenues has increased a lot. So, is it that our India business is facing some sort of headwinds on the PFT side?
Yeah, I think we've had some contracts coming to an end in India. So I think that sort of is playing out. That's playing out now. But we've got that compensated by the growth in the international revenues.
Okay, sir. That will be all from my side. Thank you.
Thank you. The next question is from the line of Salil Sharma from Kapoor Sharma and Company. Please go ahead.
Yeah, good afternoon. Most of my queries have been answered. I had just one point regarding the ESOP of 4.2 crore. What do we see that in the coming quarters?
Hi, Salil. Good to hear from you. The next quarter, so we have a total write-off on the ESOP amounting to about 11 crores left. Next quarter will be about just around 4 crores. And then over the next whole year, it will be 7 crores.
Okay. And regarding the infusion of funds by the promoter, has the total amount come in, or it will come over a period of time?
No, currently, as required, 75% of that amount has come in.
75 has come in?
Yes, 25%. Sorry, 25% has come in.
So that's around 82 crores or so, roughly.
Amounts to about 82 crores, yeah, sorry.
Okay, and the balance would come over what period of time?
So he has an outer limit of 18 months to convert these warrants.
Okay.
Well, obviously, that's something the promoter can answer, but he has 18 months to do.
Okay, so now it will give a comment on that?
Sorry?
Yeah, so I think we do have 18 months. So I think we're obviously going to see how things play out from our side, and hopefully we'll try and bring it in sooner than later. But I think at this point, I don't want to make any specific commitments on that.
Okay, fair enough. And with the success of Padmavati, are we seeing any traction in the Indian industry to take on the 3D and the VFX work?
Yes, certainly. In fact, we've got films like Brahmastra, Race 3, and other very, very big, and Robo 2. There's a whole bunch of movies that are now starting to really get activated, and they're actually looking for bigger VFX and 3D becoming part of this. Again, something we've always been waiting for, and I think we are in a great position to serve these mega projects. So, yes.
Okay, thanks a lot.
Thank you. Before we take the next question, we'd like to remind participants that you may press star and 1 to join the question queue. The next question is from the line of Dimple Kotak from SKS Capital and Research. Please go ahead.
Yes, sir. So what is your debtor as on date, as in December? Hello? Hello? Hello?
Yeah, net debt is about 1,450 crores.
Sundry debtors, sir.
Oh, debtors. Okay. Debtors is about 450 crores total debtors on the books, consolidated.
We had around consolidated debtors of 254, and that has jumped to 450 crores.
No, so what you are seeing is only the line item for debtors, but there is unbilled revenue also on the balance sheet. So that will be, it's a sort of debtor only. So you have to combine the two. And
I have to do a like-to-like comparison. Similarly, what would be for the previous quarter, as in September when you reported?
It will be similar, not much change.
Okay. And so what was the provision amount which we made for debtors this quarter?
About 10 crores, like we discussed.
So, I think if I'm not mistaken, in FY16 also we made a provision of 200 crores to write off the debtors. Again, we are seeing a 10 crores. So, I mean, do we see this trend to continue?
No, I don't think there was a 200 crore write-off in debtors. I think maybe...
So there were certain provisions and write-offs for debtors in 2016 to make the balance sheet more cleaner.
Yeah, but I don't think it was 200 crores, and certainly not on debtors. We can recheck and...
Sure, sir. No issues. So, sir,
And I think, I think let's just add to that. I think that fiscal 16, I think that was obviously quite some time back. I think it's important as the company kind of grows, and we've now coming closer to 2,500 crores of revenue on an annual perspective. I think it's, it's important the company kind of keeps looking at itself and making sure the right provisions are made. Again, at the end of the day, are these write-offs or not? I think time will tell. But I think it's just more just being conservative, making sure you take the provisions when you should. So the company size from 16 to now also has more than doubled. Obviously, this is not something we expect or plan for, all the time. But I think that's the perspective that I think we should have.
okay, so sir, any further increase in the provisions at the end of the year we'll see on the balance sheet from the 10
We don't anticipate
number?
any. We don't anticipate.
Not right now.
Okay, and sir, what would be the quantum of debtors more than 6 months old?
I don't have that data handy online, but we can send it to you offline.
Sure, sir. And sir, if you can tell me that there were plans to rebrand the international business as D negative because that has a more better brand recall. So are we on the path?
Yes, certainly. We have been planning this exercise for some time, and I think you will hear about it sooner rather than later.
Okay. And any substantial increase in expenses for marketing and rebranding of that, or is it in the course?
No, not really.
Okay. And sir, I think you mentioned that the finance cost of the additional 5.5 crores will continue. That will be the trend.
That's right.
Okay, sir. Okay.
That will continue till this time the NCDs are paid off. As somebody asked a question earlier, they are due for redemption before the end of this current calendar year.
Yeah.
So I think you're looking at another couple of quarters.
Okay. And sir, what will be the additional depreciation that will be charged for the intangible assets? As you said, it will taper down in the next few quarters. So what if you can just help me in the numbers?
Again, it's going to taper down, so I don't think there's any additional depreciation. It will continue at the current levels it is at.
Okay, fine. Okay. Thank you so much.
Thank you. Before we take the next question, a reminder once again to our participants that you may press star and 1 to join the question queue. The next question is from the line of Tushar Jain from IIFL. Please go ahead.
Yeah. Hello. Sir, my question is on the revenue recognition part, like how it happens. I just wanted a brief understanding of it, like when it happens for us in production stage or maybe post-release or some part in post-release. And second question is, like, are we affected by the success of the movies? Are we directly linked with it, the collection of movies?
So I'll take the first part first. Most of our revenue is, or largest part of the revenue is all percentage of completion. So there is, an estimate of effort required on the job, and as the effort gets, as the effort keeps mounting, we will take a percentage of that and book revenues.
Okay.
On the second part, no, we do not take an upside on the. We do not take an upside on the regular revenues of a movie. So if a movie does exceptionally badly or exceptionally well, that's not going to largely affect us.
Okay. That's it from my side.
However, I just want to make sure that everybody gets this perspective. I think what is important to know is that, however, there are times when we negotiate what are called change orders with our clients, and those change orders are basically driven by the back of the changes that happen during the course of production. And sometimes, the provisions and other actions we have to take are in line with those change orders, sometimes falling short or going up depending on exactly how that negotiation plays out, considering many, many different, views. So that is the only thing that I would say, that at times the street must be able to sort of factor that as a business reality, that we don't take any risks in that regard, except that we do have to manage these what are relatively sensitive when you've got a project in execution. If sometimes the creative changes can move the contract value quite a bit, so that's a delicate point that we have to manage with our clients from time to time. So just want to put that as an additional piece of information.
Okay. Yeah. Thank you, sir. That's it.
Thank you. Before we take the next question, we'd like to remind participants once again that you may press star and 1 to join the question queue. Next question is from the line of Janil Javeri from J&J Holdings. Please go ahead.
Yeah, hi. Thanks for taking my question. I just wanted to know what was the cash flow from operations in this quarter and for the 9 months.
Yeah, just give me a minute, Janil. From an operating perspective, the cash flow, this is from a 9-month perspective, it's 185 crores cash flow from operations.
And this quarter?
This quarter, I will come back to you with the number. I only have the 9-month numbers in front of me.
Okay, 185 crores.
Yeah, cash generated from operations.
Okay, and what kind of capex have we lined up for Montreal and any other facilities this year and next year? If you could give me a number for those.
I think this total capex will be about between 170 and 180 crores. Next year, again, the estimate is for it to be in the $25 to $30 million zone.
Okay, and this includes the maintenance, capex, everything?
Yeah, everything.
Okay, fine. All right, thank you.
Thank you. Participants who wish to ask questions can press star and 1 at this time.